If you rent, mortgage rates aren't background noise. They're the number that decides your next lease. When mortgage rates jump, your rent isn't just reacting, it's being engineered upward. This content is for educational and informational purposes only. You've probably felt it already. Your landlord used to raise rent 2% and now it's 8%, and the apartment across the street is offering 2 months free for new tenants while yours says take it or leave it. It feels random, unfair, impossible to predict. But there's a clean line running from rising mortgage rates to your monthly rent. And once you see it, the randomness disappears. Why does this matter right now? Because whether you sign a 12-month lease next week or move in 6 months, understanding this is the difference between paying more just because or negotiating from power. Here's the setup in plain English. Mortgage rates are the wholesale price of housing money. Rent is the retail price of a place to live. Landlords are resellers. When their wholesale cost rises, they try to push up the retail price. But here's the twist. The timing isn't instant, and the increase doesn't always hit where you expect. That's why your friend in Austin got a rent reduction while yours in Chicago jumped 12%. Same country, same mortgage rates, completely different outcome. The reason is simpler than it sounds. And more important, start with one building, one owner, meet Nina. She owns a 20-unit building bought in 2020 with a 3% mortgage. On a $2 million loan, her monthly payment was about $8,400. Rents averaged $1,400 per unit. After expenses, she cleared enough to cover the loan with a buffer. Fast forward to today. Her fixed rate ends, she needs to refinance at 7%. Same $2 million balance now costs roughly $13,300 a month. That's a $4,900 jump, nearly $250 per unit, just to stand still. She has 2 levers, raise rent or cut costs. You feel that as we're increasing your rent $150 and adding a $25 trash fee. It's not personal, it's math. But wait, it gets stranger. Even if your specific landlord doesn't refinance today, rising mortgage rates still raise the floor under rents through something called the cap rate. Think of the cap rate as the yield buyers demand from a building. If buildings used to sell for a 5% cap and mortgages were 3%, investors made money. Now mortgages are 7%. If cap rates don't rise, every new purchase loses money. Investors respond in 2 ways. They demand a higher cap rate, meaning prices drop, or they raise rents to make the income higher. When sellers won't drop prices enough, the pressure moves to rent. That pressure shows up in your lease. Here's what nobody tells you. Rising mortgage rates also trap would-be buyers in the rental pool. When the 30-year mortgage goes from 3% to 7%, a $400,000 home's principal and interest jumps from about $1,986 to $2,061, almost $2 more before taxes and insurance. Many households say, not this year, they keep renting. Demand doesn't vanish, it piles up. In apartments, more bidders for the same number of units equals higher rent, especially at the mid-price tiers where most people live. And that's when the real squeeze begins. Now zoom out to developers, the people who add new supply. Building a 200-unit complex needs a construction loan. When mortgage rates rise, so do construction loan rates. A project that penciled at 5% interest no longer works at 9%. Shovel-ready plans get shelved. Fewer buildings start now means fewer units delivered 18 to 24 months from now. It's like turning off a faucet today and wondering why you're thirsty in 2 hours. You don't notice immediately, then suddenly vacancy gets tight. Rising mortgage rates today are the reason your rent in 2026 may be higher than you expect. And this is where things get interesting. The rent you pay doesn't just pay the mortgage. It has to satisfy something called a debt service coverage ratio, the DSCR. Lenders want the building's net income to be, say, 1.25 times the mortgage payment. If the mortgage jumps, the required income jumps too. Back to Nina. At 3%, her annual debt service was around $800. She needed about $126,000 in net income. At 7%, her debt service is roughly $159,600. Now she needs almost $200,000. That difference is $74,000 a year. Split over 20 units, that's $308 more per unit per month before even touching increased insurance and taxes. That's the math behind your rent hike letter that never explains the math. But here's the twist that explains the weirdness you see online. Rents can fall in cities drowning in new supply from projects started back when money was cheap. Think the Sunbelt boom. Austin, Phoenix, parts of Atlanta. Buildings that started in 2021 are delivering now, and they have to fill hundreds of units fast. They dangle 2 months free, a waived deposit, a free parking spot. That's a temporary oversupply wave colliding with high rates. You get concessions even as mortgage rates rise. 2 blocks over, in an older building with a landlord facing a refi, you get a blunt increase and no perks. Same city, opposite breadth of the market. Both are true. You might be thinking, what about landlords with no debt? Great question. If a building is paid off or locked into a cheap 30-year mortgage, the owner has no immediate pressure to raise rent to satisfy a bank. Those owners often move slower. That's your opportunity. A mom and pop with a fixed 3% rate has a different risk profile than an institution with a floating rate loan resetting every month. If you can figure out which type you're renting from, you can predict how your rent behaves. Here's how. Ask friendly questions when touring. When was this property last renovated? How long have you owned it? Are you planning upgrades? Owners brag. You'll hear clues. We bought in 2020. We're refinancing next spring. New investors came in. Translation: pricing pressure or stability. There's another layer nobody explains. Property valuation changes real costs beyond the mortgage. Rising cap rates mean lower property values, but many cities reassess property taxes with a lag. Insurance premiums have been spiking. Utility costs rise. These expenses seep into your rent through rubber band charges. Utilities build back, amenity fees, pet rents. Even if the base rent stays similar, the all-in monthly check balloons. Recognize it, and you can negotiate the part with the most wiggle room, fees, rather than the base rent, which the lender cares about. So what do rising mortgage rates really mean for renters? 3 channels, 1 result. First, more demand for rentals as buying gets pricier. Second, less future supply as construction slows. Third, more pressure on existing landlords to raise income to satisfy lenders. The lag is the trap. Demand responds quickly. Supply responds slowly. Debt pressures kick in when loans reset. You're living inside those lags. Wait, there's a catch. If mortgage rates fall meaningfully, it doesn't instantly cut your rent. It can do the opposite in the short run. Lower rates pull renters into home buying, yes, reducing rental demand. But they also revive construction and building purchases, which takes time. In the first 6 to 12 months of falling rates, some landlords see an exit and stop cutting deals. Your negotiation power can actually dip before new supply arrives. Timing matters more than slogans. Remember that Austin friend? Here's what happened next. The new luxury building gave 2 months free to fill units. 12 months later, the concession vanished at renewal because their construction loan switched to permanent financing at a high rate. Their debt service jumped, and the manager needed that free rent back. Meanwhile, Nina's tenants, who negotiated a smaller increase last year, face a bigger one now as her refinance closes. The story keeps moving. All right, what can you do, specifically, so you stop feeling like a passenger? First, target landlords with old, cheap debt or no debt. Clues: older buildings owned for a decade or more, family names on the mailbox, minimal turnover, slower renovation schedules. They value stable tenants over squeezing every dollar. Offer to sign 18-24 months for a better rate if you love the place and expect more rent pressure. But there's a twist. If your city has a flood of brand new units, go the other way. Shorter lease, ask for concessions, let oversupply work for you. Those managers are bonused on occupancy, not rent purity. Second, Use calendar leverage. Winter is your friend. Vacancy rises. Leasing agents are bored. Owners hate empty units in January. Move then. Or negotiate your renewal to anchor in the off-season. Offer something landlords love. Certainty. I'll renew today if you give me $150 off and keep the parking at last year's rate. Small trade, big impact. Third, watch two numbers like a pro: the 10-year Treasury yield and local vacancy. Mortgage rates roughly track the 10-year plus a spread. When you see the 10-year jump 0.5% in a month, your landlord reads the same signal. If your lease ends in 90 days, negotiate now, not after that jump hits their underwriting. For vacancy, look at apartment listing sites and local market reports. If Class A downtown shows 12% vacancy and suburban Class B is at 4%, you know where concessions live. Fourth, test the fee stack. Ask to reduce the junk fees even if base rent is firm. Admin fee, amenity fee, pet fee, trash. A $35 trash fee waived is $420 a year. That matters. Offer an easy win in exchange, like autopay or a small prepayment. Fifth, think like a lender. Landlords need a DSCR, often 1.25. If your building's rents already cover the new mortgage with cushion, they have less leverage to push big increases. If the building just changed hands or you see a lot of construction bills, expect pressure. Ask. Are there major upgrades coming? New elevators often mean new rent targets. Here's what to watch over the next year. A wall of multifamily loans matures in 2025 and 2026. Many were taken at low rates with floating terms. As they reset, some owners will sell. Some will push rents. Some will offer deals to attract better tenants before a refinance. That means volatility and opportunity. If you can be flexible on timing and location, you can catch a discount from an owner who needs occupancy, not headlines. One more myth to clear. Rising mortgage rates always mean you should buy now to lock something. Not necessarily. For many markets, the monthly payment on a purchase at today's rate still exceeds rent by a wide margin. Run the real numbers, mortgage, taxes, insurance, maintenance, against your rent. If buying forces you to stretch, you can lose optionality just as the market shifts. Power isn't owning or renting, power is choosing at the right time with eyes open. You started with a simple frustration. Why is my rent rising when I don't even have a mortgage? Now you can trace the line. Mortgage rates rise. Buyers become renters. Developers delay. Landlords face higher debt service and higher required coverage. Rents and fees climb with lags and with exceptions where new supply hits. You're not guessing anymore. You're reading the system. Use it. Ask the right questions. Time your lease. Pick your landlord like you pick a phone plan. Watch the 10-year. Scan vacancy. Negotiate fees. Lock longer in tight markets. Go short in overbuilt ones. That's how rising mortgage rates stop being a vague headline and start being leverage in your hands. The hidden truth is simple. Rent is not just about you and your landlord. It's about the price of money upstream. When the price of money jumps, shelter reshuffles. Now you can see the shuffle, step ahead of it, and make it work for you.